Welcome to Frankly Speaking, the podcast on responsible business from Frank Bold, the European Public Interest law firm. I'm Richard Howitt, and after leading responsible business issues inside the European Parliament for many years, I host our discussion of the latest developments in the fields of corporate sustainability, sustainable finance, business and human rights. Today, how investors disclose sustainability practices. The Sustainable Finance Disclosure Regulation, SFDR, is going to be reformed. To discuss how and whether the changes are the right ones, Frankly Speaking welcomes one of the principal authors of Frank Bold's own research and analysis of the proposals. He's Senior Sustainability Finance Expert, David Němeček. Welcome, David.
Hello, Richard. Thank you for having me.
And Frankly Speaking welcomes Leo Donnachie, Senior Policy Specialist, Sustainable Finance at the Institutional Investors Group on Climate Change, IIGCC. Welcome, Leo.
Thank you, Richard. Pleasure to be here.
Leo first, the case for change. What has and hasn't worked as intended with the current SFDR from the perspective of institutional investors?
So when I think about that, I actually like to go back quite a bit in terms of years and think about what this was all intended to do in the first place and how SFDR fits within that wider sustainable finance action plan that some listeners may remember that the Commission launched back in 2018. And that action plan, that set out three pretty clear objectives. I think they're as relevant today as they were in 2018, but they're also very relevant for SFDR. And those were to kind of embed sustainability considerations more explicitly in risk management and investment decisions. It was about promoting transparency, fostering transparency in the markets through disclosure. And then ultimately, and arguably most importantly, it's about channeling capital, reorienting capital flows to things like towards decarbonisation in the context of the European Green Deal and other sustainability objectives. And I think it's instructive to think about those goals in terms of what has kind of really worked and where we maybe need to see further improvement. And on that first point in particular, thinking about how sustainability is integrated into investment processes, I think from the institutional investor perspective, we've seen some real success as a result of SFDR. If you think about where we've come, it's something like half of total EU AUM now, assets under management, are captured by products under SFDR that are either promoting sustainability characteristics or pursuing sustainable objectives. A lot more, even than that, are now kind of incorporating ESG considerations into their risk management processes. So we've really seen that formalized, and that's not going to go away. There is now a kind of real baseline for integrating sustainability that wasn't arguably there before, and I think in many ways that's been one of the biggest achievements we've seen with SFDR.
The key argument for change, though, where does it need improvement?
Well, this is it. I think when we think about those other two objectives of the Green Deal, that's where maybe we do really need to see improvements. Obviously, transparency is a big part of the SFDR. It certainly has generated a lot of disclosure, but arguably we haven't seen that kind of comparability, that ability to kind of credibly assess what's under the bonnet of some of these kind of funds that are disclosing under SFDR. A lot of the funds that we're seeing, they don't have a kind of baseline of kind of comparable sustainability indicators. It's quite hard for end investors to kind of meaningfully compare them. We haven't kind of had that clarity on some of the key definitions and concepts to really assess what is sustainable, what is a credible, sustainable investment strategy. And I'd say none of this has been helped by the fact that companies in the real economy were not disclosing, publicly or in line with corporate standards. Or I should say that they were disclosing after SFDR had been introduced. So we sort of put the cart before the horse insofar as the reporting investors need for this to work was not there. The corporates should have really been reporting first.
If I can break in there, I'd add to that, to be fair to those that argue the simplification agenda, there were a lot of critics who were saying it was too complicated and too difficult. And
Yep.
Part of the European Commission's proposal is to make it a bit easier. And what we saw was a lot of investors and finance market practitioners actually withdrawing from particularly the dark green sustainability criterion. I'll come back to you in a moment, Leo, but David, as we start with this overview, can you just tell us what are some of the most important changes that the European Commission is proposing?
Thank you, Richard. That's a great question. Actually, I might start by saying that in the original SFDR, there is several elements that needed improvement, and I very much agree with Leo on those points he just listed. So in 2024, actually, in our research that focused both on the product disclosures and the entity level disclosures, we found several issues that actually the current review of the legislation is trying to address. And first of those is the product categories. So where previously it was not entirely clear how investors should use the Article 8 and Article 9 when it comes to labeling their investment products. The current proposal by the Commission spells it out very clearly, giving the three categories of ESG basics, transition category, and the sustainable category. So that's one big improvement. Second one I'll mention is the transparency that Leo correctly mentioned there. So when it comes to investment strategy, how investors allocate for contribution of their investments, they haven't necessarily been always transparent enough when it comes to the specific methodology they used for this purpose, and so it's very I find it very useful in the Commission's proposal that they're giving a list of options investors can choose from, while keeping that list open-ended for investors that want to be more creative, let's say, and also proposing specific transparency requirements when it comes to their method. Lastly, I'll mention exclusions, and this issue is I would say follows a similar pattern. So where investors do often follow common exclusions, they are not necessarily going into a lot of detail when it comes to how they implement those exclusions. And so that's very useful, again, that the Commission's proposal is giving a clear list of exclusions that will be unified across those product categories.
On the exclusions, David, that to me, when I first look at it, looks like going backwards rather than forwards. So people in investment who are really pushing the transition say it's all about transition. And that is reflected in the new proposals, which I think broadly many people will support. But there is this strengthened emphasis on exclusions. And many people, progressive people, investment who are trying to support sustainable finance, say it's a blunt instrument. Okay, we don't putting funding into tobacco or into arms, but that's not a transition approach. How would you respond to that criticism?
I'll say, the investment in fossil fuels is something essential we need to deal with when it comes to making sure that we are really embarking on a credible transition. So indeed, it's to be reviewed by the expert community how sound those exclusions, specifically for fossil fuels, should be. I think it's a necessary element that we need to have this bottom line and say SFDR is not to accommodate for all the products out there. There needs to be a minimum ambition that we want all of these products to have. Exclusions is not the only regulatory instrument in the SFDR framework that is essential in this regard. There's also the transition plans and the engagement that certain investors might choose to require from their investees, and if the exclusions are well complemented with those elements as well, then it can give you a very different kind of level of ambition in the investees that those investors are putting money in.
There are some critics that say that companies can be classified as having sustainability goals in their investment, because they've got a strong transition story, but they're actually expanding their fossil fuel business. And Reclaim Finance says that the new ESG basics category is susceptible to greenwashing. No ex-ante sustainability aimed outcome, no clear specifics on how to assess ESG integration. Is there too much of a loophole that means that this new approach can greenwash what is essentially continued fossil fuel expansion?
Well, I think in terms of the exclusions that we have seen the Commission put forward, there are some that I think make a lot of sense. I think one of the exclusions that most of the market, as far as I can see, are definitely supportive of is around the kind of the no new fossil fuel projects. The devil will be in the detail, right, as to exactly how that will be implemented in practice. But from our perspective, that's certainly in line with the IEA and other science-based scenarios. We cannot have new fossil fuel projects if we're going to maintain that trajectory of net zero. So I think there are some very clear exclusions here that should really mitigate that greenwashing risk. You mentioned the ESG basics category, and I think this is certainly the kind of category that people have concerns may replicate some of the challenges we've seen with the sort of current Article 8 disclosures under SFDR, where it's a bit of a catch-all for everything. There's no clarity over what, the kind of safeguards. I do think it's nevertheless important to kind of recognize that there's a sliding scale of ambition here, and where you do want to create a product under the ESG basics label. The investable universe for that fund does need to be a bit broader. Yes, it needs to go further than a kind of baseline integration of ESG into risk, but nevertheless, I think with the right safeguards in place, you should recognize that it's about kind of investing in companies that are going a bit further than their peers, for example, in terms of their sustainability performance, without necessarily contributing to the goals of the transition or sustainability objectives. What I would say, maybe just quickly around the kind of exclusions more generally, is I do think in terms of how the market develops products, exclusions are more straightforward to implement. I think in terms of the do no significant harm kind of requirements that we've seen, they've been a bit confusing, I think, in terms of how to navigate those. So exclusions do make sense. It's just important that they're calibrated right. So, we have exclusions under climate transition benchmarks, Paris aligned benchmarks. It makes sense to ensure that, for a transition category, for example, you're not going further than the exclusions for a climate transition benchmark, because that might have significant implications for the universe of companies you can invest in. You want to be able to invest in those companies on a credible transition journey who may today be high emitters.
The new categories, I'm sure many people know them, but there's transition, there's ESG basics, and there's sustainable, and it's not a rising tide of sustainability in the way that the current classification seems to be. You referred, Leo, there to do no significant harm, which is a very important part of SFDR as it's existed so far, and you referred to adverse impacts. Now the new proposal continues to apply those to a product level, but not at entity level, and it seems a bit strange that requirement on looking at harm is being diluted. And for investors and for companies in these disclosure regimes, of course, the most difficult thing is to look at negatives and to be open about negatives. But here, it does seem slightly that the requirements being diluted at a time when greenwashing concerns suggest it should be strengthened. How do you respond to that?
Well, I think it's also, we need to think about how straightforward it is to implement. We had these two sort of different levels of do no significant harm in operation. We had the taxonomy kind of component, which is very explicit, focused at the activity level, and then the kind of wider company or entity level DNSH under SFDR, which I think was less readily understandable, and you had different companies, different financial market participants kind of interpreting that in slightly different ways. So I think the approach to kind of, we'll still see that DNSH component of the taxonomy, I think, retained where you are investing in taxonomy aligned activities or companies that are increasing their taxonomy alignment. I think in terms of making the framework a little bit less ambiguous, clearer to understand, I don't necessarily see that as a bad thing. And we do still, as you noted, have these principal adverse impact indicators that are operating at the fund level. Now, that's really, really important, because when you think about where adverse impacts materialize, it's really in the context of the investee companies within your fund. You want to understand what's in your fund, what are the companies you hold, what are their adverse impacts on the environment, on society, whatever it might be, and then how are you as an investor in these companies mitigating that? That's going to stay. You have a lot more flexibility in terms of which principal adverse impacts to report against under the new proposals, and that has its benefits and its concerns. I'm sure we'll come on to that. But I think in that sense, the framework is still makes a lot of sense.
David, obviously we're having this discussion off the back of this new set of recommendations that Frank Bold has come up with. And so whether it's on what we were just talking about or elsewhere, just talk us through some of the main recommendations that you're making in this report.
Thanks, Richard, for the question. But maybe just to complement a little bit what you just mentioned, when it comes to the entity level disclosures, specifically on adverse impact, I think from our perspective, that's definitely has been an essential part of the information that the users of disclosures are getting. That's disregarding of what it means for practice of investors and how difficult it might be to gather that information. But just to give you a sense also of what the expert community is proposing as some alternative options for the entity level disclosures in this regard, beside the aggregation of the pie disclosures, they would be they would have to disclose at the product level anyway. There's been ideas for having to disclose at entity level the sort of proportion you have in the categorized investments as opposed to non-categorized investments. Some experts have been also proposing having a disclosure on exposure to high impact sectors across the portfolio. So there's other options that we can think of when it comes to entity level adverse impact disclosures. But to our recommendations that reacted to the Commission's proposal for the SFDR review, principal adverse impact is definitely one of the essential elements here. We very much welcome Commission's proposal to maintain the principal adverse impact indicators disclosure at the product level. And we do propose there is a minimum set that would be mandatory for all of those products. We'd also propose to be specific when it comes to the topics that will be covered that are universal material, such as the climate change, the biodiversity loss, the human rights issues, and an extended list of those indicators that could be subject to materiality for investors to choose which of those are relevant for the particular products. Otherwise, I'll refer to one more, which is which relates to the positive contribution allocation criteria, the list of options that the Commission is giving there. Some of those options are reading quite unspecific and can be interpreted in various ways and might not necessarily enable clear comparability for the user across products. So I think having a very clear definition for all of those investment strategy options, as well as clear methodologies that investors can use, that the level 2, the kind of the technical criteria that the Commission is going to be working on in the second stage of this review are going to play an essential role here. So these are just some examples. I'm pretty sure later on we'll touch upon others as well.
IIGCC exists to engage, as David was just referring to, and yet again, some critics of the reform say that engagement is missing or largely missing from the proposals, and yet that's the real way that we will, or investors will be able, and capital markets will be able to drive sustainability transition. How does that look to you?
Yeah, I mean, our position on this is unambiguous. From our perspective, stewardship is one of the most critical mechanisms at institutional investors' disposal to really kind of drive and facilitate change in the real world. It's a really important tool for investors to meaningfully encourage improvements in both the sustainability performance, but also the financial performance of the companies that they invest in. And from our perspective, this shouldn't just be kind of an optional extra in a list. We want to see stewardship and engagement underpin all three of the product categories that the Commission have proposed at the moment. It just sits as an optional extra, really, in the transition category. An eligible investment could be one that's accompanied by a credible engagement strategy. And by the way, we don't have a clear definition yet of what a credible engagement strategy is. So that's something that needs to be fleshed out. But from our perspective, this really does need to sit at the heart of the framework. Now, of course, engagement will look different for different kinds of investment products, different asset classes. I think a lot of the focus has been on listed equity, but nevertheless, we do want to see that built into the framework. And SFDR is ostensibly an asset class agnostic framework, so we still need to kind of incorporate engagement throughout that approach. We definitely want to see that underpin the whole of the framework, much like the kind of approach that we've seen in the UK. And I think also worth noting, and in that context, we've talked a little bit about entity level disclosures and the rollback of some of those disclosures. Now, most investors will establish their approach to stewardship and engagement at that entity level, and then you talk about there's a read across into how that entity level policy has been applied at the fund level. So that's also going to be really important from our perspective. We want to have that clear link to entity level disclosures of stewardship policies under SFDR. Ideally, they're aligned with the shareholder rights directive that's coming up for review as well. But certainly, I think we would like to see this become much more front and center of the framework, rather than just something you might want to do for one transition focused fund label. The importance of engagement is relevant across the categories, and at the entity level, we still need to kind of see that link to policies and how that's then applied at the fund level.
David, at the start, Leo said one of those three objectives for Sustainability Finance Action Plan from the beginning and SFDR from 2021 was shifting more money into sustainable investment. And I think, irrespective of our listeners, whether they're deep experts on this or it's fairly new to them, that's a pretty clear and obvious aim. And yet what we saw earlier this year was a study produced by Stanford University, Harvard Business School, University of Amsterdam and London Business School, that the SFDR has almost completely failed to put more money into sustainable investment, which is a pretty remarkable finding, I have to say. Is the set of changes that the Commission is proposing going to change that, and why?
That's a difficult one, but an important one indeed, Richard. I'm feeling quite positive about the direction the Commission is proposing here for the SFDR review. Leo correctly mentioned it's one of the very early, if not the earliest, of the regulations out there to deal with this issue. Since then, we've moved quite a bit when it comes to the quality of some of our rules that we've seen being put out there. So I'm quite positive about those proposals. They do address the issues that we've identified in 2024 as some of the key ones for why there might be lack of clarity, too much wiggle room, I guess, for for investors as well. Again, more transparency and clear requirements, comparable approach to how money is allocated in the investees at the first place. It's an essential one. More detail and comparability on exclusions. Another one that's being addressed here. PI indicators are to be maintained. They're essential also to motivate the right behavior across investors. I feel quite positive when it comes to the direction Commission is proposing here.
Leo, I'm going to put the same question to you.
Yeah.
Because Morningstar Sustainalytics did some research, and they say that the new sustainability categories, the three of them, would be significantly lower than the current Article 8 and 9 categories, and that funds not categorised as sustainability related would dominate, representing between 52 and 61% of EU fund assets compared to 41% today. Mm-hmm. Now, that, what's good in this if actually it's going to be lower rather than higher?
So I guess one thing to consider here is we would expect some sort of calibration if you are introducing more prescriptive expectations around different funds and what they can and cannot do. You would expect to see the sort of universe of funds labeled or disclosing under sustainability requirements to drop somewhat. I guess the real concern there, though, is, we obviously the ultimate thing that we want to be doing here is facilitating finance in the real economy to support the goals of real economy decarbonisation and growth of competitiveness. You think about the transition category, for example. If that ends up becoming a bit of a niche, that it can only kind of credibly represent sort of a very small proportion of the fund universe, and for me, it's not really achieving its goal, its ultimate goal, which should be to help reorient capital in line with various policy objectives. I would say with all of this, and I think it is really relevant here, is that we've obviously talked a lot about the kind of the disclosure and the transparency side. And I think for a number of years, and this goes back to kind of even 2017, what gets measured gets managed, and we need all this disclosure. Disclosure alone is really just a means to an end. That's not going to shift the dial. And I think, without price signals from the real economy, without that suite of real economy sectoral policies, without a robust carbon tax, are we really going to be able to shift the dial? Of course, we need to have disclosure and transparency, but SFDR and the whole disclosure piece within the EU is just one part of the puzzle. And I do think if we join the dots between them all, SFDR will be really helpful.
And I will ask this question briefly, Leo. A big complaint from investors was that they were required to disclose things before companies were required to give them the information to be able to do so. We've now seen the omnibus and the final outcome on CSRD. Do we now have that alignment? Is it sufficient, or is that still a problem?
So I think that it is likely to be a problem still. As you've mentioned, it's a problem that everyone in the industry is familiar with. From day one, investors were trying to meet their disclosure obligations with data that didn't exist on a sufficiently widespread or comparable basis, and we now know that the scope, of course, of the CSRD has been narrowed significantly. I think there's going to a couple of things here really that are going to be very key to how this all plays out. I think there's still going to be a lot of pressure to report precisely because of regulations like SFDR, even if companies aren't in scope of reporting correct requirements directly. I think there will be that pressure to voluntarily disclose, including under the voluntary standards that the FREG have developed. Investors will be asking for this information, and certainly it won't plug the gap that a mandatory disclosure on operating on a broader basis would plug. But nevertheless, I think that will happen. It is going to be really important to ensure all the data points in SFDR are captured under these voluntary standards, I think. And also, I think, to ensure that there are safeguards in place for the use of these standards to avoid, selective disclosure, cherry picking, and so on. That's going to be really important. I also wonder as well if there could be, in light of a reduced scope of CSRD, to what extent can investors draw, and indeed companies draw, real economy corporates draw on wider standards, whether it's the ISSB, the GRI. Can we kind of allow some flexibility to, for disclosures against these wider global standards and frameworks as well, so that we make sure that investors can access that information? That's going to be so important. And otherwise, I think, we'll really struggle with a revised SFDR and new fund categories.
David, in your recommendations, you want the thresholds to be strengthened. Tell us a bit about that, please.
Essentially, what we are referring there, Richard, in our assessment of the Commission's proposal is the thresholds of the proportion of the product that needs to be allocated according to the given criteria or the selected criteria. The other one is to do with the non-categorized products, but let me start with the first one. Essentially, the Commission is proposing that 70% of the product needs to be allocated according to the selected investment strategy. And the question here is whether this is high enough, also considering the connectivity with other rules that investors have to deal with, such as the ESMA naming guidance, which is proposing 80%. The other threshold we are kind of targeting with our assessment here is the one to do with the non-categorized products. Essentially, the Commission's proposal is proposing rules to non-categorized products, which consist of some restrictions when it comes to naming of products that are not categorized and do not comply with SFDR, and then the use of sustainability-related information in their marketing materials. There, the Commission is proposing that for this information to not be central, the sustainability-related information not to be central in non-categorized marketing materials, means that this information needs to be limited at least to 10% of that respective marketing material. This essentially means that products that are not sustainable will still be able to use 10% of the space in their marketing materials for sustainability related information. This, from our perspective, might still be quite high, but I think disregarding the final number of those thresholds, there's other means also to deal with requirements for non-categorized products. One of them could be something that expert community is proposing here, is a minimum PI indicator disclosures across the market, including for non-categorized products. So not only that they would need to be restricted from naming and certain use of sustainability related information, but they will also need to do their assessment of adverse impact. Aside from some of the other proposals that the community might not still agree on, which is, for example, the option of having disclaimer for non-categorized products.
That point about non-categorized products, some critics say that the UK, United Kingdom proposals are better on that, and that there isn't sufficient rigor in the new European proposals across all of investment. So people can view your report and make up their own mind on that. Now, this is still a long process. It's going to go through the European legislative process this year. Even after that, any further changes are agreed and confirmed, you then get to European Securities and Markets Authority, ESMA, with the Commission coming up with regulatory technical standards and what are called level 2 requirements, as well as the top level legislative level 1 requirements. So there's a lot of water still to flow under the bridge, and it's going to be 2028 sometime before the new regime is clear. We'll track it on the Frankly Speaking podcast, but if I can say to both of you, this is the final question, can you just say one change that you hope to see in that process? Just a single one. You may have covered it already, but let's focus on what's important here. Leo first.
I think from our perspective, and considering this is the IIGCC standpoint, it's absolutely about getting that transition category right. We are, I think this is the most kind of game-changing proposal in the revised SFDR. It's got the capacity to really kind of support that goal of real economy decarbonisation. So let's make sure we get the underpinning criteria for that right. The focus on what matters, credible transition plans aligned with the EU CSRD. Focus on capex. Let's calibrate those exclusions so that we can invest in those companies that are going on that journey, and indeed make those wider links clear with policy initiatives like the Clean Industrial Deal, like the Savings and Investments Union.
I'll just add to Leo's remark. Make sure that those categories work for transition next to each other. They complement each other in that respect, including the ESG basics category. Let's make sure that if those products following this category are also on their way of sustainable transition, let's make sure that the requirements there are ambitious enough, and that they complement clearly the investments in the transition and the sustainable categories.
In this podcast, we've heard that positive as well as negative screening is important in these proposals. We've heard the case for a minimum set of what we've called PIs, principal adverse impacts, should be looked at again. Leo has strongly argued that entity level stewardship and engagement shouldn't be an add-on, an optional add-on. It should be strengthened across the board. We've heard that there are still concerns from investors about non-alignment with company disclosure, sustainability disclosure requirements. And Leo has argued that ESRS, European Sustainability Reporting Standards, are crucial to that, and of course those are still with the European Commission at the moment to publish. We'll be looking back at that later in the years. He also said that you can't do it all through transparency and disclosure, and that market signals a carbon tax, he said, are all part of what will actually shift finance. This can only be part of that. From David, we've heard that the thresholds do need to be strengthened. He says from 70 to 80% for sustainable investments, and some safeguards put on non-categorized products being too blurred or potentially confusing and still making sustainability claims. That needs to be controlled very carefully. The Frank Bold paper and David have argued very strongly that the level of ambition in the requirements needs to be higher. And Leo has said very clearly that the biggest innovation in this, which is the transition investment approach, is something that is very precious and very important, and something that is to be welcomed and to be safeguarded. Frank Bold's briefing analysis of the EU Commission's proposal to review the SFDR is available to download for free from the Frank Bold website. Sadly, we've come to the end of our podcast, but I would like to say thank you very much to David Němeček and to Leo Donnachie for joining us.
Thank you very much.
Thank you, Richard.
You've been listening to Frankly Speaking, the Frank Bold podcast on responsible business. Find out more about Frank Bold's Responsible Companies section on our website, and please give us your feedback on our LinkedIn page or by commenting via your podcast provider, where we hope you will share the conversation and give this podcast a 5-star rating. Remember, you can watch us on our YouTube channel too. Thank you again to David, to Leo, and to all of you for listening. Do join us next time, and goodbye.